Hi, welcome to Money 9 TV9 Network's multilingual personal finance news service. I'm Kartik Malhotra. Well, what is trending on Money 9 today is a somewhat new concept of investing. And it's a process through which you can own a bucket of stocks. But no, we are not talking about mutual funds. In fact, we are talking about this new phenomena called small cases. What are these small cases? How do they benefit you and me? Helping us understand this is Vasanth Kamath, founder and CEO of Smallcase. He's joining us all the way from Bengaluru. Hi Vasanth, thank you so much for joining us on Money 9. Please unbox this phenomena called small case investments. What are small cases and how do they differ from mutual funds?
Absolutely. Hey, Kartik, thanks for having me. Great to be here. So, in a nutshell, small cases are similar to mutual funds or ETFs or portfolio management services in the fact that they are portfolio wrappers on top of stocks. In the case of small cases, these are essentially baskets of stocks or ETFs that are created and managed by SEBI registered professionals. The other concept around it is the difference between, say, a small case and other products like mutual funds, ETFs, PMSs, are that with small cases the investor holds the underlying stocks in their demat accounts, which means that they have complete transparency into what they're holding, what the portfolio is, as well as customizability on it as well. So they can tweak the composition of a small case. For example, say you want to invest, in a sector like pharma. If you take a pharma fund, you will have to kind of invest according to the weightages that the fund manager has already decided for you. It's a one size fits all product. But then, say with a small case, if you like a certain stock in pharma, you can actually increase your exposure to that because you hold the underlying stocks. So the similarity is that both are portfolio wrappers on top of stocks. The difference is that you have complete transparency, as well as you have the optionality of control over your portfolio. But like other portfolio wrappers like mutual funds, PMSs, ETFs, they help you basically build a long-term portfolio on the equity side.
So what you're trying to tell us is that we are in fact creating a bucket of stocks. We are not investing in a fund, but we are investing pretty much directly in stocks, except we are not buying every single stock individually, but buying a bunch of stocks collectively. Is that right?
Absolutely. So I think, like if you see, how kind of brokers have evolved over the years. I think the first wave in the 90s was, say, you have to call and buy individual stocks on your broker, before which it was obviously, kind of with stock certificates. Then in the 90s, it became dematerialized shares. Then in the 2000s, it was all around, trading electronically, the last 2 decades. And right now, what small cases helps you do is basically buy a basket of stocks together, track it together, and then you can set up an SIP on it, invest more on it, or say exit partially or exit completely. So the entire behavior, or the experiences around looking at a taking a portfolio approach to stocks versus looking at them individually, which is very concentrated and volatile for most investors.
Right. So I understand I can't directly go and trade on your platform. I can't directly go and buy small cases from smallcase.com. Eventually, I'll have to buy it through a demat account or through a brokerage. So, what are the must knows, must haves that an investor should definitely keep in place before looking at investing through small cases?
No, absolutely. I think, like I mentioned, small cases are baskets of stocks or ETFs, and since these are the constituents, these are both traded on the exchange. And to invest in anything on the exchange, you need two things: a trading account as well as a demat account. So, a trading account helps you buy and sell stocks on the exchange. A demat account is where your stocks are finally held. So both of this is what you get from any brokerage firm. We have partnered with 12 brokers right now. So if you're a client of, say, an HDFC Securities, Zerodha, Upstocks, Axis Direct, Kotak Securities, and many more brokers, you can basically go to your broker or go to smallcase.com and then look at small cases and then invest in them.
Right. But, and I assume exactly like buying stocks directly, there's no lock in period. It's totally liquid. You can trade during the market hours, or is there any difference when I buy through small case?
No, no difference at all. It's the same behavior, or form factor that way. No lock-ins. There's a small case is as liquid as the constituents inside them, so you can enter a small case, exit anytime during market hours. But the major part of the investor base looks at small cases as long-term investments, so they don't use it as a trading instrument. So people generally buy, hold, and then SIP into their small cases.
Right. So just help me sort of walk me through the costs involved in this, because if I'm buying stocks directly, then there's a brokerage fee that I'm paying. So are costs any different for me as an investor, or does it work similarly as it would be for buying stocks directly?
It's the same cost again, Kartik. So when you're buying a small case, you're essentially paying all the brokerage and associated fees for buying the stocks in the small case. Some small cases also have a research fee added to that, which is where, say, since small cases are created and managed by SEBI registered professionals, for that service, for their research, for their management of the small case, they charge a fee that could be, either a fixed fee, a fixed flat fee, or it could be a percentage based fee on investment value. So these are the two costs that an investor has to pay when they're investing in small cases.
And typically, what is this research fee? You said it's a percentage of the total investments. How high is that percentage?
So it depends on the particular small case manager. So depends on the kind of small case or the type of exposure it's also giving you. But on an average, we've seen that a fixed fee is anywhere between 5,000 to 10,000 rupees a year. Say if it's a percentage of the investment value, it's between 1 to 2% a year.
But Vasant, since you're saying that it is pretty much a long-term investment tool, just like one would go in for a mutual fund or an ETF, then why not actually go in for the more popular mutual funds and ETFs rather than looking at small cases? What is the advantage that I am deriving out of small case investments as an investor?
No, definitely. So I think there are two advantages of the instrument itself, which is basically, like I said, you have transparency and customizability in the product. But how we look at small cases is as compared to single stocks. So we cater to users who have a demat account with their brokers, and when somebody's opening a demat account, they're essentially looking to invest in stocks. Now the behavior that we've seen, and which is where the perception around stock markets is that it's a very volatile, very high risk kind of a game. We wanted to simplify that and basically help investors build a portfolio with stocks in the small case format, so that they're taking a more simpler, transparent, and diversified route to that. So I think when an investor looks at building their equity portfolio, they usually start out with mutual funds. That's the best way to kind of begin your journey. But as they are looking for more differentiated, innovative products in their portfolio, that's where they go to, say, demat accounts, they go to PMSs. And within demat accounts, what we're trying to position small cases as the best way to basically take direct stock exposure versus taking it individually and increasing your volatility.
So typically each product wrapper, as you call it, or each product bucket would have how many stocks?
Uh, so it depends. According to, again, how the instrument works. For a small case, there needs to be a minimum of two constituents, otherwise it's not a portfolio, and a maximum of 50 constituents right now. But on average, we've seen the number of constituents in a small case between 12 to 15 stocks.
Right, 12 to 15 stocks in an average bucket. Okay, so help our first time investors navigate their way through it. You're saying first time investors should look at mutual funds. At what stage should one look at evolving to small cases?
So there a couple of nuances there, Kartik. So basically, when you are starting to build your equity portfolio, I think it makes a lot of sense to start out with simple options like, say, an index fund. Similar to that, in small cases, we have something called ETF based small cases. So for example, one of our most popular small cases is called the all weather investing small case, and that is a great way for someone to start investing into equities overall. So it's a basket or a small case of three different asset classes where you have equity, you have gold, and you have fixed income exposure. And all this is being provided through ETFs. So you have four ETFs in this small case, and the weightage of each asset class is according to done to basically maximize the risk reward ratio. So that's a great product for someone to start investing in equities altogether. But if you're looking at only the stock only small cases, I think it makes a lot of sense for people to start investing on the equity mutual fund side once they get comfortable with the nuances of how the equity markets work, and they want to basically then start becoming a lot more savvier, wanting to start take more control, want to be a lot more involved in the process, that's where small cases make a lot of sense. And the next step is obviously going ahead and building your own small case or creating your own portfolio based on stocks that you pick. So I think this is how usual graduation works. Obviously, there are small cases that work for completely new time first time investors as well, like the all weather investing small case. But for the bulk of the small cases, it makes sense if somebody has already tasted how equity markets works, then they come to stock small cases and eventually start investing in direct individual stocks themselves.
Right. And as an investor, do I have flexibility to pick and choose the stocks that comprise my my small case, or is that flexibility back with the person who's managing that particular bucket?
No, absolutely. So again, given that the instrument by design is where you're a shareholder, not a unit holder, so you have complete customizability or control over the constituents in your small case. We find not a lot of users actually do this. Like there is a professional managing every small case, which is where 85 to 90% of our user base actually sticks with what the manager is prescribing or recommending. But there are, say, 10 to 15% who take that optionality of wanting to say, I don't like, say, this exposure or this sector or this stock, and remove that, or think they should have some additional exposure or more weightage of a certain stock and actually increase that. So that's also possible, but again, not a lot of people are using it because they just want to stick by what the professional manager is basically recommending.
Right. And what's the cheapest entry ticket? How little do I need to invest to start my small case journey?
So minimum ticket sizes start from, I think, 150 rupees. So that's another very popular small case called the top 100 stock small case. It has basically two ETFs: the Nifty 50, the top 50 stocks, and Nifty Next 50, which is the next 50 stocks. So you basically, in 150 rupees, you can get exposure to the top 100 stocks on the exchange. Very index kind of way of investing into the market. So that's as low as you can start out with, and you can invest any amount that you want.
And how popular are these 150 rupee investments? Is there traction for them? Are there enough people looking at starting small with 150 rupees?
Yes, so what we see is basically people who go for 150 rupees small cases, or say the top 100 stock small case, are essentially people who just open their demat accounts. They're again trying to basically understand how this entire construct or this format works, where they're investing into something on the exchange and holding it in their demat. So usually we see that as the first investment, along with, say, something like the all-weather investing, because again, it's an ETF-based small case, very low volatility, asset class diversification. And once they get comfortable with that, they do a couple of SIPs. That's when they start buying the next small case, which is a more, say, a large cap small case, a smart beta small case. Then eventually go into more exotic options, like, say, thematic options, more model-based options, dividend-based options, etc.
Right. Vasanth Kamath, thank you so much for joining us on Money 9. That's a beautiful explainer. You've just given us a crash course, so to speak, on small case investments. Thank you so much and have a wonderful evening. That's a wrap on this particular episode edition of Trending at Money 9. This is Kartik Malhotra signing off. Thanks for watching. Bye-bye.